You locked in a fixed mortgage rate, did the smart thing, and thought your housing payment was finally predictable. Then one day your monthly bill jumped anyway. Same house, same loan, same rate, but somehow a bigger payment. In this video, we're going to break down why mortgage payments can rise even when the interest rate stays the same. The hidden costs most homeowners never watch closely enough. And the one part of the payment that can quietly wreck your budget. Let's start with the belief that almost every first-time homebuyer carries into their first year of homeownership, and most people never actually question it until something goes wrong. The belief is this: once you lock in a fixed mortgage rate, your housing payment is set. Done. Predictable. You know the number, you budget around it, and you move on with your life. That's the whole point of a fixed-rate mortgage, right? Stability. Certainty. No surprises. And honestly, that belief makes complete sense based on how fixed-rate mortgages are marketed and explained. The word fixed sounds absolute. It sounds like a promise. Pay this exact amount every single month for the next 30 years, and you'll be fine. But here's what almost nobody explains clearly when you're signing those closing documents. The word fixed only applies to one part of your payment, the interest rate part, and your total monthly payment is not just interest. It's actually made of several different pieces, and some of those pieces can change every single year. When your payment goes up and your rate hasn't moved, the problem isn't your loan. The problem is in the parts of your payment that most homeowners barely even know exist. So let's pull the payment apart and look at what's actually inside it. When you make a mortgage payment every month, you're not just paying down your loan. You're paying multiple things at once. They're just bundled together into one number, so it looks like a single bill. The standard breakdown looks like this. First, there's principal. This is the portion that actually goes toward paying off the money you borrowed. Every month, a small piece of your payment chips away at the total balance you owe on the house. Second, there's interest. This is the cost of borrowing that money. This is the part that's fixed when you have a fixed-rate mortgage. This number stays the same, or more precisely, the rate that determines it stays the same for the entire life of the loan. So far, so good. Principal and interest are stable and predictable with a fixed-rate loan. That part of the story is true. But then there's the third piece. And this is where things get complicated. That third piece is called escrow. And if you have never really paid attention to what escrow is or how it works, what you're about to hear is probably going to change how you think about your monthly housing cost entirely. Escrow is, at its core, a holding account. Your mortgage servicer, the company you send your payment to every month, collects extra money from you each month and holds it in that account. Then when your property taxes are due and when your homeowner's insurance premium is due, they pay those bills directly from your escrow balance. The reason this system exists is simple. Your lender has a financial interest in your house. If your property taxes go unpaid, the government can put a lien on the home. If your homeowner's insurance lapses, the lender has no protection if the house burns down. The lender doesn't trust that every borrower will remember to pay those bills on time, so they collect the money themselves, hold it, and pay it for you. From a practical standpoint, a lot of homeowners actually appreciate this. You're not scrambling to write a large check twice a year for your property taxes. It's all smoothed out into your monthly payment. But here's the part that catches people off guard. The escrow portion of your payment is recalculated every year. Your servicer does what's called an escrow analysis, usually once a year, where they look at what your property taxes and insurance actually cost, what they expect those costs to be in the coming year, and whether you have enough in your escrow account to cover them. If the numbers go up, your escrow contribution goes up. And that means your total monthly payment goes up. Your rate didn't change. Your principal and interest portion didn't change. But the escrow portion did, and the bill you get in the mail at the end of the month is higher than it was before. That is the most common reason homeowners see unexpected payment increases. And most of them have no idea it's even possible until it happens to them. So what actually causes the escrow portion to rise? It comes down to two main things: your property taxes and your homeowner's insurance premium. Let's look at both. Property taxes first. Property taxes are determined by your local government, and they're based on the assessed value of your home. That value gets reassessed periodically, in some counties, every year, in others, every few years. When home values in your area go up, the assessed value of your home tends to go up with them. And when the assessed value goes up, your tax bill goes up. Over the last several years, home values in many parts of the country climbed significantly. That's good news if you're thinking about equity. It's less welcome news when your county sends out a new tax assessment and your bill is suddenly hundreds of dollars higher per year than it was before. That increase gets spread across your 12 monthly escrow contributions, and your payment goes up. And there's nothing about your mortgage that protects you from this. Your rate being fixed has no bearing whatsoever on what your county chooses to charge you in taxes. Now let's talk about homeowners insurance, because this one has become a bigger and bigger factor. Homeowners insurance premiums have been rising sharply in many parts of the United States. This is not a subtle trend. In states like Florida, California, Texas, and Louisiana, some homeowners have seen their premiums jump dramatically, sometimes doubling or more, in just a few years. The reasons behind this are layered. More frequent and more costly natural disasters. Inflation driving up the cost of building materials and labor. Insurance carriers pulling out of certain markets entirely, which reduces competition and pushes remaining prices higher. Whatever the cause, the result is the same. Your insurance bill goes up, your escrow analysis reflects that increase, and your monthly mortgage payment rises to cover it. Put both of these together, higher taxes and higher insurance, and it's not unusual for a homeowner's monthly payment to climb by a meaningful amount without any change to the loan itself. In high-cost areas or after a major reassessment, that increase can be substantial. Hundreds of dollars per year is not an exaggeration. And because most people aren't watching their escrow statement closely, the first time they find out is when the new payment amount hits their bank account. Escrow is the most common culprit, but it's not the only one. There's a second layer of reasons a mortgage payment can rise, and some of these are even less visible. If you put down less than 20% when you bought your home, there's a strong chance you're paying PMI every month. PMI stands for Private Mortgage Insurance. It's insurance that protects the lender, not you, in case you default on the loan. It gets added to your monthly payment and can cost anywhere from a few dozen to a few $100s per month, depending on your loan size. Here's what matters. PMI doesn't stay forever, but how and when it comes off is something most borrowers don't know to track. In many cases, you can actually request that PMI be canceled once your principal balance drops to 80% of your home's original appraised value. You typically need to make that request yourself, in writing. It doesn't always happen automatically. But here's the rule that does apply automatically. For most conventional loans, PMI is generally required to be terminated once your balance reaches 78% of the original value, as long as your payments are current. Why does this matter for a video about payment increases? Because if something goes wrong with your PMI tracking, if your servicer miscalculates, if you get behind and the automatic cancellation gets delayed, or if a new fee gets attached, your payment can tick upward in ways that feel unexplained. Some borrowers also use something called a temporary buydown when they buy a home. This is when the seller, builder, or lender essentially subsidizes a lower interest rate for the first 1, 2, or 3 years of the loan. It's designed to make early payments more manageable. But when that buydown period ends, your payment goes up, sometimes by a noticeable amount, because now you're paying the full rate you agreed to at closing. If you got into a home using a buydown and didn't fully understand the terms, that payment jump can feel shocking even though it was built into the loan from the very beginning. And then there are servicer mistakes and new fees. This one is less common, but it happens. Mortgage servicers can make errors in escrow calculations. They can fail to apply payments correctly. They can add fees, sometimes legitimate, sometimes not, that inflate your monthly obligation. If your payment went up and none of the other explanations seem to apply, it's worth looking closely at your loan statement line by line, because servicer errors do occur and they are not always caught quickly. Now we need to talk about a scenario that is less common than escrow changes, but significantly more damaging when it happens. It's called force-placed insurance, and it can hit you in a way that is both sudden and very expensive. Here's how it works. Your mortgage servicer is required to make sure your home is insured at all times. If they can't confirm that your homeowner's insurance policy is active, maybe your policy lapsed, maybe your insurer dropped you, maybe there was a clerical mix-up and your servicer didn't receive proof of coverage, they will buy an insurance policy on your home themselves. And they will charge you for it. That might sound like a convenience. It is not. Force-placed insurance policies are almost always dramatically more expensive than a standard homeowner's policy. In some cases, several times more expensive. And the coverage they provide is designed to protect the lender's financial interest in the property, not yours. If something happens to your home, a force-placed policy will not cover your personal belongings. It may not cover a range of damages that a normal policy would. So you end up paying far more every month for coverage that does less for you. And because that cost gets added to your escrow or your monthly payment, the number on your bill can spike significantly, sometimes with very little warning. The way to protect yourself from this is straightforward. Never let your homeowner's insurance lapse. Make sure your insurer sends proof of coverage to your servicer each year and confirm that your servicer has your current insurance information on file. A phone call can prevent a very expensive problem. If your mortgage payment increased and you don't understand why, here are the concrete steps to take, in order. First, read the escrow analysis statement. Your servicer is required to send you an annual escrow analysis. This document breaks down exactly what's in your escrow account, what it pays for, and how they calculated your new monthly contribution. If you haven't read it, find it. It will usually tell you directly why the payment changed. Second, identify whether taxes or insurance drove the increase. Look at your property tax bill from your local government and your homeowner's insurance renewal notice. If either number went up significantly, that's almost certainly the source of the payment increase. Knowing which one is causing the problem tells you where to focus next. Third, if property taxes went up, consider appealing the assessment. Many homeowners don't realize that property tax assessments can be challenged. If you believe your home was assessed at a value higher than it's actually worth, you can file a formal appeal with your local tax authority. The process varies by location, but successful appeals can result in a lower assessment and a lower tax bill. Fourth, if insurance is the issue, shop your policy. Your homeowner's insurance premium is not fixed. You can get quotes from other insurers. If your current provider has raised rates significantly, a competing insurer might offer meaningful savings. Even if you've been with the same company for years, it's worth comparing. Lower insurance costs mean a lower escrow requirement and a lower monthly payment. Fifth, check your PMI status. If you're still paying PMI, calculate what percentage of your original loan balance you've paid off. If you're at or near 80%, contact your servicer and ask about requesting cancellation. Don't wait for it to happen on its own. The automatic termination at 78% is a legal requirement, but making a proactive request at 80% can get it removed sooner and save you money. Sixth, if nothing explains the increase, call your servicer and ask for an itemized breakdown. You have the right to understand every line of your mortgage statement. If the numbers don't make sense, call and ask for a written explanation. If you believe there's an error, submit a written dispute. Servicers are regulated, and they're required to investigate and respond to written complaints. Here's how I want you to think about this going forward. A fixed-rate mortgage is a powerful tool. Locking in your interest rate is a smart, real form of financial stability, and don't let anyone take that away from the narrative. That part of the promise is real. But a fixed rate does not mean a fully fixed payment. The total number you pay each month is layered. Principal and interest are locked. But property taxes change. Insurance premiums change. Escrow requirements change. PMI comes and goes. Buydowns expire. And servicers can make mistakes. The homeowners who get blindsided by payment increases are almost always the ones who set up autopay on day one and never looked at their statement again. The homeowners who stay in control are the ones who treat their mortgage like a living document, something worth checking every year, not something to forget about because the rate is fixed. Read your escrow analysis when it arrives. Compare your insurance premiums every year. Track your loan balance relative to your home's original value. Know where you stand. Because the rate being fixed is not the same thing as the payment being frozen. And the difference between those two things, if you don't understand it, can absolutely catch you off guard. If this video changed how you think about your mortgage payment, share it with someone who recently bought a home, because most new homeowners go years without knowing any of this, and it only comes up when the damage is already done. And now I want to hear from you. Has your mortgage payment ever gone up unexpectedly? Did you figure out why? And were you able to do anything about it? Drop your experience in the comments below.